Hey guys, this is Steven, founder of Phoenix FXC. Just wanted to go over a quick video on your development or your trading development plan. And this is why you need a trading plan. Anybody who is new to trading needs to build a trading plan. They need to have a detailed, well thought out plan that can, honestly, it will dramatically increase your results for so many reasons. Can guide you on what to do when you're unsure what to do, help you think clearly about what next steps to take, improve your overall development, stop you from getting emotional because you can just follow the plan. Um, Lots of good reasons, guys. Now, here's some quick tips for your trading development plan, and I recommend all of you follow these. First, leverage your time wisely. It's important to use your time wisely when learning, well, anything, honestly. Treat your time like it's worth gold. Treat your time like, basically, time is money. And if you treat it like that, all of a sudden you stop doing the small things that are distracting you from reaching your goals. If you're spending a lot of time staring at charts but not making a lot of money, chances are you either lack a trading plan or you may need to revise the one that you currently have. Part of your trading plan should outline exactly what you're going to mark up on your charts. It should include how long you're going to spend marking them up, how long you're going to spend analyzing, how long you're going to spend trading, how long, or actually deciding your risk to reward ratios, your acceptable losses. Like, when are you going to cut a trade? Where's the line? When have you gone too far? What your strategies that you're going to use are, what kind of analysis are you going to use, etc. Second, don't trade blindly, ever. If you're ever unsure if the trade will go in your favor, just don't take the trade or take it on demo. And then if you do take it on demo, I recommend you study why the trade either failed or why it succeeded. What components went into that? Was it a fundamental thing with news? Was it a fully technical thing? Was it market structure? Was it a pattern? Was it a reversal? Was it Fibonacci? Was it based on market sentiment and the herd kind of moved it there, or did institutions move there? Did the smart money move that way? Figure those things out. Otherwise, when the markets go too far in the opposite direction, how do you guys expect to be able to prevent yourself from freaking out? Some of you guys are going to exit out of trades before it has a chance to move in your favor. And, if you can learn to control yourself, you're not going to lose as much money. Those who don't learn to control themselves, those who take trades blindly, you're likely to lose more money. Third, and this is one of the most important things that I can really recommend to you, is never chase the money, guys. Never chase the money. It's vital to utilize proper risk management. It's just key, but part of proper risk management, so when people say this, part of this is don't chase the money. Chase the setup. Everybody wants to make money, but without learning how to trade properly, you're going to lose. My rule of thumb, learn how not to lose money first, then focus on trying to learn how to make money. Because the point of being a successful trader is not to open a trading position and make $100 on a $300 account. That's like insane gains, and it just doesn't always happen. The point is not to double your account either. If you've got a $50 account, the point is not to double your account overnight. The point is to use proper risk management and use profitable strategies in order to win trades more often than you lose. If you can win 60% of the time, you're considered profitable. And that means if you lose 40%, those 40%, they don't matter because you're winning 60% of the time. That's most of the time. And doing so, you can safely grow your account. If in a single day you can make multiple trades to grow your account by just 1 to 5% and risk only 1 to 5%, this is great. One day you make 1 to 5%, 2 day you make 1 to 5%, third day you lose 1 to 5%, you're still up 1 to 5%. Boom. That's how you safely manage your account. Making 5% of your account even daily, every day of the month, with maybe even, let's say 5, days where you lose 5%. Again, overall, you're winning, and that's the point, to win overall. You can leverage compounding. Gain a little bit, just a tiny bit at first, and slowly those gains get bigger and bigger and bigger, and they grow your account. It's like a snowball effect. This is part of how experienced traders succeed, is they're properly leveraging and risking their account for the safest and most profitable capitalization, guys. Another thing, this kind of goes back in with what we just discussed, but it's okay to lose. It isn't important to focus on winning every time. We kind of just touched on this. Your focus should be first to learn how to lose the least amount of money possible, then learn how to make the money. I mentioned that in the last slide. That's a key thing. I'm mentioning it twice now. This should tell you it's important. However, keep in mind that, like we said, 60% of the time to be profitable. As long as you stay consistent, use proper risk management, and so on, your losses really shouldn't matter that much to you. Key point here, learn how to lose less money, then learn how to make it, and it's okay to lose. Backtesting. It's important to backtest your trading on demo. This allows you to lose absolutely no money while you're figuring out which strategy is best for you to use. Come on, guys, demo. It's there for a reason. It's easy. Some people like to say that they don't like demo because you don't get the real emotions involved. Well, the real emotions can come as a stage 2, but stage 1, learn how to freaking use MT4 first. Learn how to place an order. Learn what a support and resistance level is. Learn about technical analysis. Learn a little bit about fundamental analysis. Just learn a little bit before you try to dive in and get those emotions involved. Get some knowledge behind what you're doing first. Then if you want to try trading and using the emotions to catalyze and speed up your trading, great. Go for that. However you choose to do it is ultimately, it's your choice. But these are recommended ways that we've seen people utilize and win. So take it or leave it. But once you can successfully flip a demo account a couple of times, chances are you guys you can consider taking on a live account and starting to trade. We technically can't tell you to do it, but at that point it might be a good idea. Just remember, keep your mindset and emotions in check when trading your real money, because when you switch from demo over to live, there's not a difference in the market. There's a difference in your mentality. There's a difference in your psychology and your emotions. So just be aware of that. Another thing, keeping a trade journal. Now, an easy way to keep track of progress is to write down the trades you take, how you felt. That's important. A lot of people forget that. Why you took the trade in the first place. That's another good one. And what happened with the trade. Most people write down what they did and what happened. Don't forget to write down how you felt and why you took the trade. Why? History is going to keep repeating itself unless you learn from history and then change it. Literally, just learn from your mistakes. Failure is one of the best teachers, guys. Hands down. Let's move into mindset and emotions. We'll give you a little bit of information. We're not going to go over it too much because we've done another video on this. It's a lot more detailed. So for any trader to be successful, you've got to learn to master your mindset and emotions while trading. Having a good mindset and controlling your emotions can make or break your profitability. This is 100% true, guys. If you cannot get your psychology down, if you cannot get yourself into a good mindset while trading and keep that mindset and keep your emotions in check, you are not very likely to make money. You are very likely to keep losing. So, mastering your mindset and emotions should be one of the top priorities you have as a trader. This might go for your entire 10-year or 50-year trading career, or your 2-year trading career, however long you choose to trade. Master this. Always focus on this. We have a very detailed video on mindset and emotions at phoenixfxc.com/bootcamp. Check it out. Don't forget. Now, let's move into risk management. We're going to go briefly over risk management, touch on a few key factors, and then we'll move on. So, first thing you need to decide in risk management, how much do you want to risk? Many traders will talk about 1 to 5% risk management. I've seen traders say don't risk more than 1%, more than 3%, more than 5%, more than 10%. you generally don't see a lot of them go past 10%. That's when it starts to get really risky. I mean, if you have $100 and you go past 10%, you're starting to lose more than $10. Watch later. I'll give you the link, or I'll point you to where our detailed risk management video over. You'll see why that's a bad idea to lose $10 out of 100, even though you don't think about it might be. It is because of leverage and margins and everything. So anyway, it just means decide what percent of your account do you want to risk at any given time or in any given trade. I mean, not risking more than 1% of your account is considered very, very conservative, and the growth of your account will be slower. I mean, the less you risk, the slower the growth. The more you risk, the faster the growth, but the more you could lose. So there's that caveat. But that's just how life goes. So it just comes down to how much risk versus the reward. How much do you want to gain versus how much do you want to lose? I am a balanced person. I like to gain a little bit, but only lose a little bit. Over time, as you get more experienced, you'll lose less because you'll focus on learning how to not lose money, and you'll gain more. So your risk to reward will end up being more rewards. Following a 5% approach, if your balance is $100, guys, then 5%, $5 is conservative but safe approach, because it means you would only stand to lose the $5. That's great. You know, if you can risk the $5 but make $10, boom. That doesn't seem like much, but it adds up. Believe me, because if you just stop and think about this for a moment. You got $100, you risk $5, you make $10. You do that 3 times. Now you've got 130. You're now 30% up on your account. 30%. Okay? Now, let's say you lose $5. So you're 25% up on the account. You've got 125. No big deal, because now you're going to make 2 more 5%. You're going to get to 135 and be 35% up. You see how that stops, how the losses stop mattering, but those wins really stack up, and before you know it, you're at 170, you're at $200, and that starts compounding. Now you're trading with a $200 account because you've doubled the $100. Soon enough, you're going to get that 200 faster as it doubles to 250, to 300, to 400. Once it goes from 200 to 400, now you've quadrupled the account. And it just keeps snowballing like that. That's called compounding, and it's really important to trade that way because it's less risky and it's slow to start off, but man, does it snowball, and it gets bigger and bigger and bigger, and it stays safer. So, just to touch on this, the higher amount you risk, the bigger the risk of your account of getting margined out. You don't want to get margined out, and you don't want to blow your whole account. If you get margined out, it's going to stop the trade, and you're going to lose whatever that trade was in the negative. So you don't get to hold it anymore. Because sometimes you can let trades hold for a little bit in the negative before they're going to go in the positive based on your analysis. And if you have too many trades get margined out, that's when we blow the account and you're done. I mean, nobody likes this feeling. Believe me, the first time I experienced it, it's the most gut-wrenching feeling. But again, that's part of mindset and emotions mastery, is you've got to learn to take those losses and not let money matter. You know, you've got to unattach yourself from it. So now blowing your account, margining out, winning money, not winning money, it's going to depend on lot sizing, account leverage, and how many other open positions you do or don't have open, margins and equity, etc. And again, I'll give you the link to where you can find that video. So we'll touch on this last piece of risk management. So for proper risk management to work, you should be targeting at least 2 times what you're risking in a conservative approach. Now keep in mind, we're consultants, we're not financial advisors, we're not instructors, we're not telling you what to do with your money. We're giving you what we do so that you can copy it and be profitable yourself. So just keep that in mind. But if you're taking profits on an account of an increase of 5%, then your risk should be 2.5%. If you're risking 5%, you should be looking to take profits around 10%. This is a 1 to 2 risk to reward ratio. The reasoning behind this is that, for example, we kind of touched on this a little bit, so we're going to go more into depth. If you keep the risk at 5% and the reward at 5%, then you can maximize your growth and minimize loss. Now, keep in mind, this is only a moderately conservative approach. I already mentioned that. Many Forex traders, as I mentioned in the very beginning, some 1%, some believe in 10%, but a huge goal in trading, this is a key point right here, major key. A huge goal in trading is to make sure your account survives to the next day. Really, you want it to survive as long as possible, obviously, but if you can at least get to the next day, you're one step further. But you need to pick the risk to reward ratio that's going to work best for you, because at the end of the day, you're responsible for whether you win or lose. Nobody else is responsible. Nobody else is forcing you to take that signal. Nobody else is forcing you to push that button. If you push it and you're going off someone else's analysis, it's because you want to. Never forget that. Literally, it's because you want to. And 9 times out of 10, it's because of your greed. Control your emotions. I'm going to keep touching on a lot of these points like that because they're so important. But with a 1 to 2 risk to reward, you can win today, lose tomorrow, or lose today and win tomorrow again. We kind of touched on that in the last slide. Again, it's all about being able to trade another day. Now, we just discussed how vital it is to apply proper risk management in your trading plan. Now, I know a lot of you probably have questions like, okay, well, how exactly do I implement a 1 to 2 risk to reward ratio, Stephen? I mean, what lot sizes do I use? What leverage do I put on my account? You know, how exactly is this done? To learn how to properly do this, phoenixfxc.com/bootcamp. Look for the risk management video, very detailed. It will walk you through this. Now, let's move on to some basic analysis, which is important for any trading plan. So we'll start with fundamental analysis. You should always plan for news. Every trader needs to remember is to check and plan for news so that you don't end up going on the wrong side of a trade. Even if your analysis was good, it can happen. You can check for news at phoenixfxc.com/forex news. When you hear fundamental analysis, most of the time people think news. So just remember to plan for this. It's important to keep in your trading plan. Now, basic fundamentals. One of the bigger things you can pay attention to in fundamentals, the interest rates. Higher interest rates can raise the value of a currency. Inversely, lower interest rates can lower them. Other things to pay attention to are strength of the dollar index, gold indexes. You can compare the dollar index to recent interest rates as well. Strength and bias of the stock markets, because stocks have a play in the U.S. economy, and the U.S. economy has a play in the entire world's, every economy in the world. So commodities are another thing. Tip, learn to analyze oil and gold because they heavily tie into many different nations' economies. Treasuries, bonds, market reports, and recent events. A lot of news that comes out is going to be market reports and events, so keep that in mind. Now, another thing about planning for news, learn to study the macroeconomics, the economies themselves, like I said, interest rates, and just more aspects of fundamental analysis should be something on your trading checklist. So to check out our detailed video on fundamental analysis, again, phoenixfxc.com/bootcamp. So we're going to touch on sentiment analysis, which is the third kind of analysis. So for market sentiment and psychology, you might hear the term herd mentality. It's a good idea to figure out what the general herd of traders is doing in the market right now and, well, avoid doing this. Typically, most of the herd is literally being led around and or trapped into certain market situations by institutions, market makers, brokers, banks, etc., all in order for these guys to make their profits. So it will take a while, but work on spotting the moves that just look out of place from where you think the market should be heading overall, and avoid falling into these traps. It's okay if it takes a while. Just keep this in the back of your mind and focus on spotting these. So let's get into technical analysis. Everybody who plans to trade the markets should get at minimum, a basic understanding of technical analysis, although we recommend learning as much as you can of technical analysis because it's so common. It's probably the most common type of all three. So we're going to go over some basic technicals you can incorporate into your trading development plan. First, is the market going up or down? One of the easiest ways to start when you're trying to figure out how to trade is determine whether the overall trend of the market pair you're analyzing is going up or down. This is called determining the directional bias, market trend. This is important because trading against the trend can often be a very bad idea and can result with you losing a lot of money. trading with the trend is considered a good rule of thumb. There's two major types of trends or directional bias, which is uptrend, you'll hear the term bullish, and downtrend, you'll hear the term bearish. Down, bear, up, bull. And then other types of market conditions, we've got ranging, where it's just kind of flat, it's doing nothing. Typically, you can scalp, just so you know, you can scalp where you enter here and you take profit here and you enter again here as long as it doesn't break out. And then you go back down here, take profit here as long as it doesn't break out again and again and again. But if you're not experienced at trading, this can make you lose a lot of money. And when I say experienced, I just mean practice this. Again, go back to demo, practice this. A ranging market's great for scalping if you can get the hang of it. Otherwise, you want to do what we call swing trading, and I'll get into this. Other type of market condition is a reversal. So you can see the market's in a downtrend right here, ranges for just a minute, and then it starts to go up, and then it goes up again. And this would be the reversal point, where it goes from a downtrend, bounces, retests, and starts reversing upwards. So reversals. A lot of traders trade off of reversals. This is where they make their money. They'll go enter here, they'll hold it all the way down here, maybe take profit here or maybe take profit here, depending on what whether they miss it or whatever they're trying to do. And then they'll wait for this point right here to enter again, and then they'll trade until it goes all the way up, and then it'll reverse again. And the market does this. It does it in levels and waves and cycles. So just keep that in mind. All right, so this is a picture of a market uptrend. You can see higher highs and lower lows. Uptrend. It's pretty simple, guys. Remember, higher highs, lower lows. This is an easy way to tell if you're in an uptrend or a downtrend. Higher highs, high, higher high, higher high. Low, higher low, higher low. Okay, so we got this. All right, and downtrend, bearish. Now we've got lower highs, lower highs, lower highs, right? It's pretty simple. Just learn to spot this in the market, because it's going to help you. You don't want to trade against the trend until you're more experienced, and even then, you still have to be careful. All right, so let's give you some time frame tips. Higher time frames are generally what most traders trade on, like the 60-minute, the 4-hour, the daily, sometimes even the weekly. And if you're really got a lot of capital, you're going to be holding for months. But higher time frames can tell you the directional bias of where the market is currently at. So what is the market doing right now? Is it currently an uptrend? Is it currently a downtrend? Is it currently ranging? What is it doing? Because the higher time frames are more reliable for what the market's currently doing. Lower time frames are good for finding clues where the market is heading next, and can even help you gain more precise entries in those reversals, those market structure, those patterns and stuff. One of the key things you need to be focusing on for your trading development plan, every week figure out what are the key levels, or every month figure out what are the key levels of support and resistance when you mark up your charts on the higher time frame, 60-minute, 4-hour, daily, weekly, even monthly. Figure out these key levels and plot them, because you can use these for entries. You can use these to figure out where price is going to hit. These can be great confirmations for entries and even exits, so you know when to get out and when to get in. A lot of people struggle with how do I know to get out? How do I know when to get in? Support and resistance levels. Another thing is daily highs and lows. Another way to get out and another way to get in is daily highs and lows. Determine the daily highs, determine the daily lows. Can help you understand where the market started, at a low or at a high, and where the next directional bias might be. This can lead you into trend trading, swing trading, and trading at market levels. I mentioned that over here, where people can enter here, hold it all the way down here, wait for this right here, then enter again. That'd be swing trading. Trading off the market levels, because you have a level right here, you have a level right here, and then third level, fourth level, and then the market kind of just ranges for a bit, and then you have level, 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 and all the way up here. So now, big thing you want to do, look for market structure and patterns. The market has tons of patterns that repeat themselves all the times, and each moment passes, the market's forming these patterns, which make up market structure. Market structure is made up of support and resistance levels, supply and demand zones, structure patterns like double tops, double bottoms. Inside of that is the candlestick patterns, and a whole bunch of stuff. Learning this, like I already mentioned, can help you plan entries by determining if the market's going to proceed in the current way, if it's going to continue a trend, if it's going to reverse, or you can just trade off the patterns sometimes. So here's some common patterns right here. Feel free to pause this. A channel is not necessarily a pattern. It's kind of a structure with patterns inside of it. And this is support, resistance, support, resistance. So just be aware of this. Feel free to pause if you want to take a look. These are some candlestick patterns. Candlestick patterns are good for reversals. They're good to know when to enter, when not to enter, and when to get out. If you're already in a trade and you see a candlestick pattern that's going to go the opposite way of what your bias is, so if you're buying and you see a candlestick pattern that says sell, you can know when to exit and then go in for a sell if you want. And then supply and demand zones. Supply, demand, when there's lots of demand, you're going to buy. There's lots of supply, you're going to sell. It's pretty easy once you get the hang of it and back test a lot. You can see some patterns right here, patterns right here. So what's your next step in technical analysis? Like I said, remember to backtest all your technical analysis strategies. Everything I'm talking about and everything you learn about, backtest it. Get in the habit of backtesting. That's how you'll stop yourself from losing so much money. I know it's a pain because you just want to make money right now, but backtesting, being patient, mastering your mindset and emotions, it's going to help you make money instead of losing it. And a lot of people lose money. Don't be one of those people. So your next step after this should be get more advanced as you can. Learn more about technical analysis. There's so many different things like Fibonacci, divergent, I've already mentioned market levels, time zones, advanced candlestick patterns, more than just what I showed you, so much more. Dig in, guys. There's so much to learn. So let's get into actually creating a basic trading plan here. All right, so first, decide what types of analysis you want to use. You've got traders who only do technicals, and they'll swear up and down that technicals are the king and there's nothing else that matters. And then you've got traders that are like, dude, sentiment analysis, where is that? Market psychology, pivots, all that stuff is where it's at. Then you got traders that are like fundamentals, economics, news, that's all that really makes up trading. Me personally, I use a combination of all three, but you'll have traders that do technicals and fundamentals. You'll have traders that do sentiment and a little bit of technicals, or a little bit of technicals and a lot of fundamentals. I mean, just decide what you want to use of these, learn about them, and go with it and practice it. Backtest, backtest, backtest. Then decide when you want to trade. Rather than trading all the time, figure out what times work best for you to trade. There are several different sessions, which I'll go over in a minute, which you can choose from, and they range in volatility and what they do, and complexity, and so on. Once you figure out what time you want to trade, next figure out what days you want to trade. Typically, the best days to trade are usually Tuesday, Wednesday, and Thursday. All the other days are kind of a toss-up. Fridays, when the market closed, honestly, it's usually a setup for how they're going to screw people who don't know what they're doing on Monday. Sunday is just kind of the market's opened. They're not really trying to screw anyone, and aside from gaps, they're just kind of getting started. And when I say they, I mean the institutions, the banks, the people that actually really move the markets and economies. And then you have Mondays, which that's kind of when they start to try to screw people. That's when they start to fake people out. Yeah. Monday's kind of like a Friday, only Friday's when they're setting things up more so, and Monday's when they're executing. And then Tuesday, Wednesday, Thursday, that's when the real moves are made. This is when the market's most volatile. There's more pips to catch, more money to be made, etc. Trading every day is not a necessary thing, guys. Remember that trading should not tie you to a desk all day. The goal is not to go from a job to sitting at a desk all day, babysitting your trades. The goal is to become financially free. You're not going to do that by trading every day. So figure out the best times. Figure out your sessions, when you need to sleep, when you need to trade. Figure out that timing. Time management is a key thing. All right, so market open and close. Pause this, take a look at it. Sunday, 5 p.m. EST, closes on Friday 5 p.m. EST. I go by EST. I don't go by GMT. Market sessions in GMT. Since I go in EST, I'm going to look at these with you guys. Feel free to pause this. These are really important. Know when these are. A lot of people trade London. There is a ton of volatility and movement in the market from 3 a.m. to noon EST. America and New York, same thing. America and London are big financial centers, so there's lots of movement here. Tokyo is another big financial center. This is a big thing. Sydney, figure out these sessions. I've got some of my best traders that I know love Asia, and some of the other traders that I know say that Asia's worthless, that you can't trade anything, that you're not going to make anything. But I'm not kidding you when I say I know traders that kill it on Asia and they make so much money. But then again, I know traders that trade London and they make a lot of money. It all comes down to what your master. What time works best for you, go master it. So let's get into short-term trading versus long-term trading, because you need to decide what kind of trader you are. You need to decide if you want to sit in front of a computer and make short-term gains, otherwise known as short-term trading, which can include scalping, which is basically where scalping is like you're getting 5 to 10 pips, and if you want to go risky, you can place high lot sizes and make a lot of money. If you want to go conservative, then you're just making $10 here, $20 here, $50 here, and just stacking that up and compounding. But you have to sit by the computer a lot to do it. If you do short-term trading, then you can place these short-term trades that aren't quite scalps, where you're still going to catch a smaller amount of pips, but you can walk away for a minute. You just got to come back and monitor it. And then you've got long-term trading, whereas you place a trade, you're going to be holding this for at least a couple of days, maybe for a whole week, maybe for 2 weeks, depending on how long-term the trade is. A lot of people like that method because you can walk away and forget about it and then make a whole bunch of money. Because that's what it's good for, catching a lot of pips and making a whole lot of money. The only problem with that is it takes a lot of capital unless you use enough capital with very, very conservative lot sizing, very conservative leverage. Basically, what you can't have happen, because what's common in long-term trading is a drawdown. You'll have a period where you're buying and it's up and you're in profit, and then you'll have a period where you sell and you may be in the negative for a little bit. If your lot sizing and leverage and risk management is off, when you go into that drawdown period, your account won't be able to hold it. Or if you have too many trades, if that one trade is got good risk management, but you have too many other trades, then you're going to get margined out because you won't be able to hold it. So that's why most people prefer bigger capital for long-term trading. But you can do it with smaller term trading if you're smart about your risk management. So just keep that in mind. And then there's a mix of both of these, which I kind of prefer, which is intraday. Intraday is you still get a decent return, but you're holding it usually throughout the day. You can hold it from day open to day close. You can hold it for a few hours. You're going to get more money than scalping, less money than long term, but a good middle ground. And then pinpoint your areas of improvement. You got to be honest with yourselves, guys, or you're never going to improve. Failure, like I've already mentioned in this, failure is one of the best teachers. The only way you're going to get better is by accepting what you need to improve upon and just put in the work. Don't try to escape it. Don't avoid it. Just put in the work and improve. I already mentioned keeping a trading journal is going to help immensely with this, obviously, because if you can go back and look at your failures, you can improve upon your failures, and you can get better and better every time. Don't forget to update your trading plan periodically to incorporate the areas of improvement you need to make. Your trading plan needs to evolve with you, guys. And then decide your focus. Not everybody can learn and get good at everything at once. For many people, it helps to pick areas of focus on what to improve on. Do you want to improve on technicals? Do you want to improve on fundamentals? Get that news trading down. Mindset and emotions. This is the biggest area where most people have to improve on, is the mindset and emotions. Like, hands down, I see more traders mess up with this. Even guru traders that claim to be so great, I see more people mess up on this part than anything else. And then your risk management. Maybe you want to get better at that, because a lot of people mess up on that too. But pick an area, focus, improve, and then move on to the next area. And rinse and repeat this till you see substantial progress in everything. You don't need to try to do everything at once. Pick one, focus, improve, move on. Boom. Before you know it, you're going to be better and better at everything. Set goals, guys. This is another key thing. Decide how many pips you want to catch in a day and set a goal. Try to reach that goal every day. And then when you consistently hit it, raise the bar. Try to get more pips. This is how you improve. You push yourself. Don't get stagnant. Don't get complacent. Don't just get good and be like, oh, I'm good now. I'm going to go start my own trading signal service. I'm going to go start my own company or whatever. I mean, I'm not saying don't do that, but I'm not saying don't do that and then stop improving. Always improve. Always get better. And then decide how fast you want to pace yourself in the learning process. I see people with unrealistic expectations that say, I'm going to be super profitable and make $2,000 a month in trading in 2 months. It's possible, but you have to be realistic and push yourself and put in that kind of work. Typically, I see 6 months to a year for traders to really get it, because Forex has got a big learning curve unless you've got a really good mentor. Mentors can drastically speed up everything. And luckily, we've got a good mentorship program at Phoenix FXC. So decide those 2 goals, and then add any other goals that you want to add. Just set the goals and achieve and strive for them. And then last thing, guys, always strive to improve. You should always strive to improve, not only for yourself, your skills, your knowledge, but strive to improve your trading plan. I already mentioned, let your trading plan evolve with you. Over time, your trading plan, it needs to update with you, it needs to evolve with you, and it needs to get better because you need to get better. If your trading plan's not evolving, you're probably not evolving. But if you are evolving and your trading plan's not evolving, why not update it? It just makes sense to keep going and keep striving and keep improving. Sometimes, guys, it's just necessary to revise that trading plan in order to make the next leap. So this is how you can put together a trading plan based on all of these things. Feel free to go back over this, take notes, watch our other bootcamp videos because all of these things tie together. I've got videos on compounding your account because I've mentioned that here. I've got a video on padding your account in swing trading. I've got video on mindset and emotions because people really struggle with that. Fundamentals, sentiment analysis, technical analysis. We've got videos on a whole bunch of stuff. Go over those things because they all tie into how you can do your trading plan. This just gives you a blueprint, a direction for, okay, I'm in the Forex world. What do I do now? This is what you do. Follow this, improve this, make it your own. Now, if you want some more free education, guys, phoenixfxc.com/education tab or phoenixfxc.com/library. Just remember, I touched on this earlier, but we are consultants. We are not financial advisors. We don't tell you what to do with your money. We consult you on what to do, on what we do really, and so that you can copy us and become more profitable. And if you want some paid education, we've got our phoenixfxc.com/trading school. We've got a great mentor program. I already mentioned that a mentor can drastically speed up your profitability. It can drastically speed up your learning process. Why? A mentor's been there. He's made the failures that you're going to make. He's gone through the process already. And our mentorship program is literally the cheapest out there. And it's the highest quality. I mean, we give away for $100 one time what people try to sell for $500 to $1,000 to $5,000. So, all right, guys, thank you for watching. I'd love to see you all improve. Please post your progress in the Facebook group, facebook.com/group/PhoenixFXC. I want to hear from you guys. I want to know how you're doing. I want to see how you're doing. I want to see those profits. I want to see you improve. And if I can help, if my team can help, we will help. Don't be afraid to contact us on phoenixfxc.com or phoenixforexconsultants@gmail.com. Hit us up on Telegram too. We're always there. That's where a large portion of our operation goes on. Guys, thank you so much for watching, and have a great day.